Welcome to the Deep Dive, where we take these, really complex reports and data and just boil them down into something you can actually use and remember.
Yeah, the essential flavors.
Exactly. And today, we are jumping into something pretty wild. It's an AI trading system that claimed a 100% return on capital.
In just over 2 months.
Right. A little over 60 days. And it was all done using futures contracts, though, on a demo account. We should be clear about that.
Right, but that headline figure, doubling your money in 60 days, it's designed to make you stop and look. But what we're really interested in is what's under the hood.
For sure. And we have the data to really dig in, not just on the wins, but the messy parts, the mechanics of how it all happened.
And our sources for this are just fantastic.
Yeah.
We have a testimonial video that kind of lays out the story, the strategy.
And then we have the full, detailed performance report, which gives us all the raw, unvarnished numbers.
Yeah, so our mission here isn't really to, prove or disprove the claim. It's to understand the trade-offs. We're digging into how they scaled up so fast, the actual performance metrics they hit, and maybe the biggest surprise of all,
The fee.
the incredible jaw-dropping friction from brokerage fees. It's a huge part of the story.
Okay, let's unpack this. So the setup, the developers behind this AI were really clear that this isn't just, some indicator you plug into a chart.
No, not at all. This is a dedicated, sophisticated AI software platform. That distinction is actually pretty crucial.
Why is that?
Well, it suggests a certain level of complexity, right?
Right.
And the ability to operate independently of a broker's standard toolset. It integrated with brokers like NinjaTrader and Tradivate.
Who are basically the same entity from an integration standpoint.
Exactly. They share the same backend. And also TradeStation, which is where the developer actually runs a public real money trading blog.
Okay, so that shows you that the system is built for real-world deployment, not just, playing around in a simulation.
Right. So this 60-day sprint we're looking at, it began on October 15th. They started fresh with a $50,000 demo account.
And we can really break the whole thing down into two distinct phases based on how they were trading.
Phase 1. It ran for 1 month, from October 15th to November 15th. This was let's call it the cautious part, the initial test.
Just to see if the algorithm actually worked before they turned up the heat.
Precisely. They used a pretty low-volume strategy, focusing only on micro futures contracts. We're talking 5 MNQs, that's the micro NASDAQ, and 5 MES, the micro S&P 500.
So the smallest, least risky way to trade the big indexes.
Yep. But it wasn't just indexes. In that first phase, the system was also trying its hand at other micros.
Oh, right, I saw that. Like micro crude oil, micro gold.
Micro Bitcoin futures, even. Yeah, it suggests they were kind of testing the waters, looking for stability across a few different markets first.
And it seemed to work, right? The account grew.
It did. It grew steadily. It hit $60,000 by the end of that first month, so a $10,000 gross profit. And the win rate was decent, about 57%. Seems solid.
Okay, but here's the number that just completely changes the story for me. We found that the system generated a gross profit of around $21,000 in that month.
Right.
But the net profit, what they actually kept, was only $9,500.
It's pretty shocking when you see it like that. If you do the math, that means they spent nearly $12,000 on commissions and fees.
Just to make $9,500.
Yep. Over half of the gross result from the algorithm was just gone. Instantly evaporated by transaction costs.
Wait a second. If you blow through 12 grand on commissions to net under 10, doesn't that just kill the whole strategy at that scale? It feels like the system is just, at best, a break-even engine.
It absolutely does. And the developers, they clearly saw the same thing. That shock of realizing that half their money was just leaking out in fees is exactly what triggered the big shift into phase 2.
They realized the micros just weren't cutting it.
The velocity wasn't there. They couldn't outrun the friction. So around November 15th, they flipped the switch.
And this is phase 2, the mini scale-up. And this wasn't some small adjustment.
Oh, no. The developers themselves said they chose to, and I'm quoting here, tenfold the configuration.
Tenfold. Wow.
So this meant switching completely from micros, the MNQ and MES, to the big brothers, the mini contracts, NQ and ES.
They kept the number of contracts the same, 5 of each. But the value of those contracts, it's just a whole different world.
It's a dramatic increase in leverage. And they were honest about it in the report. They called the leverage insanely high.
And the results were, financially they were explosive. They started phase 2 with 60 grand.
And the account just skyrocketed. By December 9th, it hit $99,900. Basically a 100% return from the $50,000 start.
And that was even before recovering from a huge drawdown that happened later.
What's really fascinating, though, is how the efficiency changed with that scale. In phase two, the system made $80,000 in gross profit, and the net was $39,000.
So the friction was still high, but the profits were just so much bigger that the net number really surged.
Exactly. Which sets us up perfectly for the next part. The true cost of doing business here.
Right. When we combine both phases, the real story of this kind of high-frequency trading it lays itself bare in the summary. This is the part you should probably remember.
Let's look at the big totals over the whole 60-plus days. The AI generated a massive gross P&L of just over $100,000.
$100,630 to be exact. That's the raw power of the algorithm.
The final number, the total net P&L, was less than half of that. It was $49,378.
So just under 50 grand.
Which means, if you do the subtraction, they spent an incredible $51,251.93 on commissions and fees.
$51,000. That's basically the size of their entire starting capital.
It is, and it completely neutralized half of their potential earnings.
That's a luxury car they spent just on fees.
Yeah.
In 2 months. That context is wild.
Yeah.
And it brings us back to that question. Why were the fees so high? Especially for a system built for high volume.
And this is where it gets really interesting because it says a lot about the economics of futures brokers. The source explicitly said they ran the demo using the most expensive commission rates available.
So it was the worst case scenario, basically.
Right. It was a testing environment. It wasn't optimized for cost at all. The developers knew this was a problem.
They mentioned something about a lifetime package, right?
They did. They noted that for any serious real-world use of this system, you'd have to buy the special lifetime rate, which drops the commission way, way down to a much lower 9 cents per contract.
Okay, so the lesson here for anyone looking at automated trading is non-negotiable.
Absolutely. For these systems that rely on a huge volume, tiny little edges, the transaction cost isn't a secondary thought. It is the primary factor in whether you're profitable or not.
If they'd been running on that 9-cent rate, the net profit would have been totally different.
Oh, it would have been dramatic. Maybe in the high 80, even 90,000s.
So running a test where you spend 51 grand to make 100 grand gross, that's a 51% friction rate. It shows that this algorithm, while it works, it's also extremely brittle.
Its survival depends entirely on getting better rates. The success isn't about the AI being smart. It's about being fast and efficient with volume.
Which brings us to the next section. Just how fast and efficient did this thing have to be?
It was relentless. The sheer volume is what defines this system. Over the 60-day period, the AI executed, get this, 13,528 trades.
13,500. That's a staggering number of decisions.
It's huge. And with that volume, we can figure out the frequency. The average trade time for all those transactions was just under 20 minutes.
19 minutes and 57 seconds.
Yeah, so this confirms it's a high-frequency scalping system. It's designed to grab quick profits from tiny price movements.
And what about the accuracy, the win rate?
Overall, the profitable trade rate was 65.54%, which is very high. They also noted that during that second phase with the mini contracts, the win rate actually peaked at 68%.
Which is right in line with what the platform claims it can do, that 68 to 70% range.
Right. But here's a really important detail that often gets missed in these reports. It's about how a trade is even counted.
Okay, let's slow down on this because this is a huge analytical point.
Yeah.
How does the AI define a trade versus how the broker does?
So the AI platform, its own system, defines one trade when the system exits the entire position.
The whole thing.
The whole thing. And this matters because these systems often use techniques like scaling into a position or averaging down. So it might enter the market multiple times to build or manage one single strategic idea.
So one decision by the AI, like I'm going short on the NASDAQ, might involve 3 or 4 separate buy or sell orders.
Exactly. But the broker, NinjaTrader in this case, it counts one trade for every single one of those initial order entries.
Ah, I see.
So the developers claim that this difference in how you count diminishes the number of winnings in the broker's report. They're basically saying their internal strategic win rate is even higher than the 65% we see here.
That's like the difference between counting a whole fishing trip as one activity versus counting every time you cast your line.
Perfect analogy. It's a powerful internal metric. But let's look at the risk it took to get there, because this kind of speed and scale requires massive risk exposure.
It really did. That aggressive phase 2 with the minis, the volatility was just incredible. The account had a huge run-up, almost $63,000 in gains between mid-November and early December. So if we just step back for a second and summarize the whole path to that 100% return,
Yeah.
what we're really seeing is a strategic choice to just embrace extreme leverage and volume.
It was a very conscious scaling strategy. They went from these diversified low-volume micros and just accelerated into high-leverage minis, and they pulled it off by maintaining a very high win rate and just running a machine that executed over 13,000 trades.